Imagine this scenario. A massive corporation finishes out their taxable year.
Okay, I am picturing it.
Yeah. So they do the math, they look at their quarterly payments, and they realize they've actually overpaid their taxes by 1,000,000 pesos.
Wow. Which, I mean, is usually a good problem to have.
Usually, right? So they check this single tiny box on their final tax return that says they want to carry that 1,000,000 peso credit over to the next year.
Standard move. Very standard.
But then, fast forward 12 months, a global pandemic hits.
Oh, no.
Yeah. Supply chains freeze. The corporation is staring down bankruptcy. They're missing payroll, and they desperately need that 1,000,000 pesos back in cash just to survive.
Right, they need liquidity. Badly, yeah.
Exactly. So they march down to the Bureau of Internal Revenue and they say, listen, we made a mistake checking that box. We are dying here. We need a cash refund.
And let me guess, the BIR says no.
The BIR looks them dead in the eye and says no.
Yeah, it is brutal.
It's so harsh. Why does that happen? Because of one ruthless paragraph in the Philippine tax code.
And, for a CPA board exam candidate, it is one of the most brilliant, just devastating traps an examiner can lay for you.
Oh, absolutely.
They will construct that exact heartbreaking story in a multiple choice question, really hoping your empathy will override your knowledge of the law.
So true. So if you are grinding through your tax syllabus right now, feeling the pressure, trying to memorize 1,000 different deadlines and exceptions, just take a deep breath.
You are definitely in the right place.
Welcome to ICPA Review Radio. Today, we are taking a deep dive into the Philippine National Internal Revenue Code, specifically sections 74 through 77.
Right, which govern the declaration of income tax for individuals and corporations.
Exactly. We're going to track the escalation of tax compliance by, following the lifespan of a business.
Yeah, we will start with the relatively straightforward rules for a sole proprietor, then watch what happens when that business scales up into a corporation.
And finally, we will walk right into that devastating trap we just described.
Because the Board of Accountancy examiners, they just love this territory. It really tests whether you understand the mechanical compliance machinery of the tax system.
Okay, let's unpack this. We are starting at the very beginning of the entrepreneurial journey, section 74, dealing with individual taxpayers.
Let's do it.
Let's invent a guy.
Rad.
We'll call him Ben. Ben is a sole proprietor, and he's running a small neighborhood bakery in Manila.
Ben is the perfect example here because Section 74A dictates that if you are an individual receiving self-employment income, like Ben's Bakery, you are legally required to make and file a declaration of your estimated income.
For the current taxable year.
Right, exactly, for the current year.
And just so we are crystal clear for the exam, when the code says self-employment income, that isn't just retail shops like Ben's.
Oh, definitely not.
It includes professionals practicing their trade, right? Like freelance graphic designers or partners in a general professional partnership.
Precisely. And it applies whether that bakery is Ben's only source of income or, if he also works a night shift at a hospital and gets a salary.
Oh, right. The mixed income earners.
Yeah, mixed income earners still have to file this declaration for their business side.
Okay, so what's the baseline rule for the filing date?
The baseline rule is that Ben has to file this declaration of estimated income on or before May 15th of that same taxable year.
Okay, got it. So basically anyone making a peso outside of a standard employee paycheck is filing this on May 15th.
Well, actually, hold on.
Did I fall into a trap?
You did. If you apply that blanket logic on exam day, you will lose a point.
Wait, really? Who gets a free pass on declaring estimated income?
It's not so much a free pass as it is a difference in jurisdiction and the tax mechanism itself. There are two major exceptions you must memorize.
Okay, let me grab my imaginary notepad. What are they?
First, non-resident Filipino citizens, specifically regarding their income from outside the Philippines. And second, non-resident aliens not engaged in trade or business in the Philippines.
Okay, let's slow down and translate that second one, because I know review materials always abbreviate it as NRA and EDB.
Right, the dreaded alphabet soup.
It just looks so intimidating. So, a non-resident alien, not engaged in trade or business, let's call him Sven.
Sven works for me.
Sven lives in Sweden. He doesn't own a bakery in Manila. He just bought some shares in a Philippine corporation, and he collects dividends.
That is a great way to visualize it. If we connect this to the bigger picture, The reason Sven doesn't file a declaration of estimated tax is because his Philippine income, those dividends, is subject to a final withholding tax.
Okay.
The tax is literally chopped off the top before the money even leaves the Philippines. He has no business operations to estimate, and, well, the government already has its money.
That makes total sense. And for the first exception, the non-resident Filipino citizen working in, say, Dubai,
Right.
we only tax them on income derived from sources within the Philippines.
Exactly.
So asking them to file an estimated tax return on their Dubai salary
Yeah.
is just pointless because there's no Philippine tax on it anyway.
You've got it. The logic is sound, but, under the pressure of the exam, candidates see a phrase like non-resident alien not engaged in trade or business as option C, and they panic.
Because it sounds so complicated.
Exactly. They guess blindly. Just remember the why. No local business operations or no local taxable income means no Section 74 requirement.
All right, so let's jump back to Ben the Baker. He operates locally. He has taxable business income, so he's definitely filing.
Yes, he is.
But how is he paying? I mean, the government doesn't just wait until December 31st and ask for a massive lump sum, right?
They definitely do not. The government has its own bills to pay throughout the year. So Section 74B requires this estimated income tax to be paid in 4 installments.
Okay, I want to give you, the listener, a memory trick to lock these installment dates in.
I love a good mnemonic.
Think of the acronym MNNM, like an obscure superhero. MANM.
MANM, okay.
Yeah, May, August, November, and May again.
It is highly effective. Let's attach the specific dates to that. The first installment is due at the exact time you file the declaration we just talked about, which is May 15th of the current year.
Right.
The second installment is August 15th. The third is November 15th.
So MAN, May 15th, August 15th, November 15th. Those are the first 3 quarters.
Yep.
But let's look at that final M, the 4th installment, because I know this is where the exam trap is waiting.
This is a critical update, yes. Republic Act number 1963, better known as the Train Law, amended this specific provision.
Okay, what did they change?
Under the current law, the 4th installment shall be paid on or before May 15th of the following calendar year.
Wow. Which is completely wild when you first hear it because the deadline for filing the final annual income tax return for individuals is April 15.
Exactly, and that is exactly what the examiners will use against you. They will put April 15 as option A for the 4th installment deadline.
Hoping your brain automatically associates the final tax payment with the annual April 15 tax day.
You got it. It's a very sneaky trap.
So why did the Train Law push that 4th estimated payment all the way back to May 15th of the following year? What's the logic there?
Well, think about the administrative reality of a small business owner. By April 15, Ben is finalizing his actual annual return. He is tallying every receipt, reconciling every expense.
Yeah, it takes a lot of time.
Right. By pushing the 4th installment of the estimated tax to May 15, it essentially aligns the final estimated payment with whatever balance is determined after the dust settles on the annual return.
Oh, that's nice.
Yeah, it gives the taxpayer a bit of breathing room to reconcile their true liability before making that final payment.
That is a lifesaver of a detail.
Yeah.
May 15th, August 15th, November 15th, and May 15th of the following year. Stick to Man M.
Stick to Man M.
Here's where it gets really interesting. What if Ben's financial reality completely changes mid-year?
This raises an important question. Let's look at Section 74C. First, how did Ben calculate his estimate to begin with? By definition, for an individual, estimated tax means the amount they declared as income tax in their final return for the preceding taxable year, minus allowable credits.
So Ben is essentially assuming this year will look exactly like last year.
Exactly.
Right, but let's say it's June, and a huge food vlogger discovers Ben's Goopandasol.
Yeah.
A video is viral.
Oh, I love Goopandasol.
It's the best. So suddenly, there's a line around the block every morning. Ben is making triple what he made last year.
That's a great scenario.
His May 15 estimate is now a joke. It is way, way too low. Does he just shrug and wait until next year to pay the difference?
The BIR is not going to let him just sit on that cash.
I figured.
The law explicitly states that if, during the current taxable year, the taxpayer reasonably expects to pay a bigger income tax, they shall file an amended declaration.
Why do they file it?
During any interval of installment payment dates.
Ah, so he has a legal obligation to correct the math. When August 15 rolls around, he needs to file an amended declaration showing his new, massive expected income and bump up his installment payments accordingly.
Correct. The system allows for self-correction. The government wants its fair share of that viral you Pandesal money in real time, not 12 months later.
Okay, so Ben's Bakery is incredibly successful. He's making so much money that his accountant tells him it is time to scale up.
A very natural progression.
He transitions from a sole proprietorship and incorporates the business. Welcome to Ben's Bake Shop, Incorporated.
Has a nice ring to it.
Right. But as soon as he does that, the Man M dates vanish, right?
Entirely. We cross over into Section 75 and 77 now. The corporate rules are a completely different animal.
Okay, how so?
Well, the individual taxpayer is on that fixed Man M schedule, but the corporate taxpayer is on what we should call the 60-day sprint, and they calculate their taxes on a cumulative basis.
Let's focus on that word, cumulative, because the computation questions on the board exam are going to try to break your brain with this.
They absolutely will.
I've heard people compare it to a basketball game, but honestly, that analogy always confused me.
Yeah, it doesn't quite fit.
Because you don't subtract first quarter points from the halftime score. I think a better way to visualize the corporate tax calculation is filling a bucket with water.
Okay, I like where this is going. Walk us through the bucket.
So imagine the corporation's total tax liability for the year is a giant bucket. At the end of quarter one, Ben's Bake Shop calculates its tax on its quarter one net income.
Okay.
Let's say it is 100,000 pesos. Ben pours 100,000 pesos into the bucket.
Simple enough. That is his first quarter summary declaration.
Right. Now, quarter two ends. Ben doesn't just calculate his tax on quarter two in isolation.
No, he does not.
He has to combine his gross income and deductions from quarter one and quarter two. He is looking at the entire first half of the year.
The cumulative total.
Exactly. Let's say the tax on that combined 6-month income is 250,000 pesos. The bucket needs to have 250,000 pesos in it right now.
But he doesn't write a check for 250,000 pesos.
Exactly. He looks into the bucket. He sees the 100,000 he already poured in during quarter one.
Right.
So to reach the required 250,000, he only needs to pour in an additional 150,000 pesos for quarter two. You calculate the tax on the year-to-date total and then subtract the tax you've previously paid in the preceding quarters.
That is the perfect way to explain the cumulative basis under Section 75. You are always solving for the total year-to-date liability and deducting previous payments to find the current cash due.
It's so tricky if you aren't paying attention.
It is. Examiners will give you quarter two's standalone income and try to trick you into just taxing that standalone amount. You must add it to quarter one first, apply the tax rate, and then deduct the quarter one payment.
Okay, so the math is cumulative. But what is the deadline? When does Ben have to actually pour the water into the bucket?
The absolute magic number to memorize here is 60.
60, got it.
The corporate quarterly declaration must be filed and the tax paid not later than 60 days from the close of each of the first 3 quarters of the taxable year.
60 days. So for a calendar year corporation, quarter one ends March 31st. They have 60 days from March 31st to get this done.
Right, which lands on May 29th or 30th, depending on leap years.
And I want to emphasize a detail you mentioned earlier. This 60-day rule applies whether the corporation uses a calendar year or a fiscal year, right?
Yes, and that is a classic MCQ trap. An exam question might say, Corporation X uses a fiscal year ending in October. When is their second quarter payment due?
And candidates who only memorize calendar year dates will just freeze?
Exactly. Just count the months to the end of the quarter and add 60 days. The rule does not care when your year starts. It only cares that 60 days have passed since the quarter ended.
So Ben's Bake Shop, Inc. has 60 days to figure this out. Where does he actually file this paperwork?
Good question.
Because Section 77 gets very specific about the logistics. And I know this is prime territory for a which of the following is not type of question.
Oh, definitely. According to Section 77A, there are 4 primary authorized places to file, assuming the commissioner hasn't directed otherwise.
Okay, what are the 4?
They must be filed with either the authorized agent banks, the revenue district officer, the collection agent, or the duly authorized treasurer of the city or municipality.
Wow. Okay.
And crucially, they must have jurisdiction over the location of the corporation's principal office or where its main books of accounts are kept.
Let's give the listener another quick recall aid here. Just remember the acronym ARCT.
ARCT.
Like the Arctic Circle, but ARCT.
Mm-hmm.
Authorized agent banks, revenue district officer, collection agent, treasurer of the city or municipality.
That is really helpful.
If an exam option suggests filing it at the SEC or, the local barangay hall, you know it's wrong because it doesn't fit ARCT.
ARCT works perfectly, and Section 77C deals with the timing of the payment. It enforces a strict pay-as-you-file system.
Oh, meaning you can't delay the payment.
Exactly. The income tax due must be paid at the time the declaration is filed.
So you can't file the return on day 45 to be safe and then hold on to the cash until day 60. You hand over the form, you hand over the money.
Exactly. Simultaneous compliance.
Okay, so Ben's Bake Shop, Inc. survives the first 3 quarters. They ran the 60-day sprints. They poured the right amount into the cumulative bucket.
Yep, they made it to the end of the year.
Now the taxable year ends. We arrive at Section 76, the final adjustment return. And listener, I need you to lean in because this is where businesses make catastrophic, irreversible mistakes, just like the story we opened with.
This really is the climax of the corporate tax year. Section 76 requires every corporation liable to tax to file a final adjustment return.
And this return covers the total taxable income for the entire preceding calendar or fiscal year, right?
That's right. And Section 77B sets the deadline. It's on or before April 15 if using a calendar year, or the 15th day of the 4th month following the close of a fiscal year.
So Ben looks at the bucket. He calculates the absolute final tax due for the whole 12 months. And, I mean, what usually happens is that the total of those quarterly payments he made doesn't perfectly match the final tax liability.
It almost never matches perfectly. The code gives the corporation 3 distinct choices to reconcile this.
Okay, let's hear them.
First, if they underpaid, meaning there isn't enough water in the bucket, they simply pay the balance of the tax still due.
Okay, that's the easy one. But what if Ben overpaid? What if he poured too much in during those first 3 quarters?
If the corporation overpaid, they have 2 options to recover that excess. Option 2, they can carry over the excess credit to the succeeding taxable quarters.
Okay.
Or option 3, they can ask to be credited or refunded with the excess amount paid, which often involves getting a tax credit certificate or TCC.
So back to our scenario. Ben's Bake Shop overpaid by $1,000,000 pesos. Ben is filling out his final adjustment return, and there are literally little boxes to tick at the bottom of the form.
Yeah, the literal check boxes.
He ticks a box that says carryover. He figures, hey, we are highly profitable. I'll just use this $1,000,000 peso credit to pay my Q1 taxes next year. It's basically prepaying.
A very standard, very common corporate strategy.
But then the scenario from our hook plays out. A crisis hits. The economy tanks. Ben's Bake Shop is hemorrhaging money.
It's falling apart.
They suffer massive net operating losses. They have 0 income tax liability for the next 5 years. That $1,000,000 peso carryover credit is completely useless because there is no tax due to apply it against.
Not at all.
Ben is desperate for liquidity. He goes to the BIR to ask to change his option to a cash refund, and the BIR denies him. Why is the law so merciless here?
What's fascinating here is how absolute the language of Section 76 is. It states, and I quote, "Once the option to carry over and apply the excess quarterly income tax against income tax due for the taxable quarters of the succeeding taxable years has been made, such option shall be considered irrevocable for that taxable period."
Wait, there's more to that sentence, right?
There is. It finishes with, "And no application for cash refund or issuance of a tax credit certificate shall be allowed, therefore."
Irrevocable for that taxable period. That phrase is just a brick wall.
It is the ultimate point of no return. Examiners will draft multi-paragraph problems detailing a corporation's tragic financial ruin.
Just to play with your emotions.
Yes. They will describe the bankruptcy, the unpaid employees, the desperate letters written to the Commissioner of Internal Revenue begging for a tax credit certificate instead of the carryover. They are actively trying to manipulate your sense of fairness.
They want you to think, surely there's an emergency exception for bankruptcy. But there isn't.
There really isn't.
Listener, I want you to write this down, highlight it, and put a star next to it. Carryover is concrete.
I love that. Carryover is concrete.
Once you pour it, it sets. It hardens. You cannot mold it back into a cash refund. You cannot change your mind. Carryover is concrete.
That is the exact mindset you need for the exam. Be cold, be calculating, and stick to the letter of the law. If the problem says they ticked carryover, the answer is no refund, no TCC, period.
But let's ask the question every tax student asks when they first learn this. Why? Why is the Bureau of Internal Revenue so unbelievably stubborn about this? It feels almost punitive.
It feels punitive to the taxpayer, sure. But if you look at it from the government's perspective, it is purely about administrative survival.
Okay, let's unpack that.
Imagine if there was no irrevocability rule. Imagine the administrative nightmare the BIR would face if major corporations could constantly flip-flop between asking for cash refunds and carrying over credits every single time their quarterly financial outlook shifted.
Oh, wow. Yeah, a company would check carryover in April, have a bad May, amend the return to ask for a refund in June, have a great July, and try to amend it back.
Exactly. The BIR would be processing endless amended returns. They would be cutting refund checks, canceling those checks, issuing tax credit certificates, revoking them, and constantly recalculating the national revenue projections.
It would be total chaos.
Absolute chaos. By making the carryover choice strictly irrevocable, the BIR forces the corporation to make a definitive strategic choice, saving the government thousands of hours of administrative waste.
When you understand that the BIR wrote this rule to protect their own sanity and their own resources, it stops feeling arbitrary.
Right.
It makes perfect logical sense from a macro level. Understanding that why is going to help that rule stick permanently in your brain.
When you grasp the mechanics behind the policy, the rules stop being just random facts to memorize and they start feeling inevitable.
All right, we have covered some heavy, high-stakes ground today. Let's make sure everything is securely locked in before you walk into that testing center. Let's hit the exam day checklist.
Okay, number 1 on the checklist. The MNM dates for individual estimated tax installments, May 15th, August 15th, November 15th, and May 15th of the following year.
Don't forget the train law update.
Right, do not let outdated test banks fool you. Remember, the train law moved that final date to May 15th of the following year to align with the final reconciliation of the annual return.
Awesome. Number 2, the corporate 60-day sprint and cumulative bucket.
Yes.
For the first 3 quarters, corporations file their summary declarations on a cumulative basis within 60 days following the close of the quarter, regardless of whether they use a calendar or fiscal year.
Perfect.
And they file it at the ARCT, authorized agent banks, revenue district officer, collection agent, or treasurer.
And number 3, our absolute non-negotiable rule. Carryover is concrete.
Say it louder for the people in the back.
The absolute irrevocability of choosing to carry over excess corporate tax on the final adjustment return under Section 76. Once chosen, there are no cash refunds and no tax credit certificates. It is locked in for that taxable period.
Those 3 takeaways alone are going to save you so much time and so many points on the multiple choice section. Keep that concrete rule in mind as you continue your review.
Absolutely.
Keep pushing through the syllabus, keep visualizing the mechanics behind the law, and keep trusting the process. You have the determination, and now you have the deep knowledge to conquer these sections.
Best of luck to you all.
Thank you for joining us for this deep dive review session. Now take a quick break, grab some fresh coffee, and go crush those practice problems. You've got this.